Okay, hello everybody, and welcome to this week's edition of Selfwealth by Syfe live, the technical analysis edition here with Jason McIntosh. How are you, Jason?
Hey Rog, I'm good. I'm good. Looking forward to another show with you. We're just talking before coming on that I was saying how cold and unpleasant it is in Sydney today. So coming online, doing this with you is a nice distraction from the unpleasantness outside.
Well, Neville concurs with you. He's in Illawarra and he hates the wet and wild weather that's happening up there as well. So, look, you got to get used to it. You know, it happens down here in Melbourne every second day, right? I know you guys aren't used to it, but even throughout summer. So, I'm sure everything will be fine up there. Hopefully, everything will be fine up there. Obviously, my name's Roger. I'm from Selfwealth by Syfe. Obviously, welcome everyone on the other side of the YouTube or Facebook or wherever you're watching this. Obviously. Thanks for coming once again. Hopefully, we're going to have a great show. We've got markets on all-time highs. Everyone's running hot, despite some of the bad news once again that's happening in the world. But it seems like, unfortunately, wars do bring this out of the markets, right? So, and it's been proven over time. Jace, but before we get on to that, let's get on to our disclaimer, if that's okay, please.
Yes, so everything we do today is general commentary only, no personal advice in any of this. I'll quickly pop up the disclaimer that we use each week, and that just goes through that. I'm also not part of the Syfe Self-Wealth team. I'm motion trader. My details are at the top, licensing, etc. And beneath there, we've got the Self-Wealth note all about licensing, general commentary, all that is in there.
Yeah, fantastic. Thanks, Jason. Now, I mean, you've been through, I made a comment about wars and stuff like that. Now, you've been through a few cycles of the markets over the last 30, 40 years. Can you elaborate on what sort of I've said? I saw a great graph, which I wish I brought it up for this show, but it was just showing how the markets have always gone up after a war has been implemented in the world or started in the world. Have you noticed that yourself over your experience?
Yeah, it'd be interesting to see a chart, and rather than me just rely off.
I'll bring it next week.
Yeah, it'd be really good to have a look at rather than me just relying offhand about thoughts I might have, because often what our thoughts of what's happened in the past can sometimes vary from what actually happened. So looking at a chart and being able to like see things is it's a good way to see how it plays out. There's probably plenty of good examples to have a look at over time.
Yeah, I'll bring it next week. And obviously, we don't know if the war is directly correlated to the US markets that are at all-time highs now, right? But it's just interesting to see how history has shown. Like you like going back in the past, Jay. So maybe we'll share that. We can share it with the viewers if you haven't seen it, because it is very interesting to see, despite the sad stuff that happens in the world, right? But let's get on to our.
Sorry, Roger. Just reminds you, it's an interesting quote I was thinking of, which I read once. It was it went along the lines. I think it goes back to Napoleonic times. It was buy on the cannons, sell on the trumpets. So it's the same sort of along the same line of buy the rumor, sell the fact. It's like the idea is when people are nervous and people think this must be the worst time to buy, it's often a good time to buy. And then when everyone's celebrating and thinks, well, now this is plain sailing, things must go up, things invariably come down and correct. So it's it'd be interesting how that plays out when you look at a chart on conflicts over time. It probably won't work out exactly like that, but I think you get the drift of it. It's like a lot of good investing and trading can be counterintuitive at times, not all the time. We go with trends and stuff, go with what's working. But at extremes, they can be counterintuitive.
Yeah, exactly. Well, I'm sure we'll still be in similar situation next week anyway. So it'll be very relevant to the times. And even though we're talking a little bit around fundamentals, it is interesting just to touch on these things and see how history is played out, right? So, all right, we've got plenty of tickers to get through already today, Jace. The crew has come firing. Obviously, it's a hot market, so which is great to see. Thank you, guys. Let's get on to our... First of all, we're doing our three general markets. So let's get on to our Australian market before we get on to everyone's individual tickets. Thanks, Jace.
Okay, so starting with the ASX 200. And so ASX 200 is into its third week of consolidation after making a recovery high in the first week and a half of June. And as we noted last week, this is the longest consolidation since that low back in April. Look at all these other ones during the rally. Very short. This is the longest one at about three weeks. One of the features of this market over the last couple of months is that it has been stretched above the 50-day moving average. That's this red moving average. That's a 50-day. Beneath there, I've got the 100-day. So that's been a feature of the last couple of months. It has been stretched above the 50-day moving average. So from that perspective, what we're seeing now really does fit the bill for a typical consolidation where the moving averages catch up to where price is. The ASX 200 got close to the 50-day moving average about a week or so ago. Before then having a rally from near the average. But mate, look, I think there's probably a good chance that prices do maybe consolidate a bit further before possibly having a retest of the 50-day moving average in the maybe the days or the next week or two. I think that what distinguishes the recent rally from the sort of rallies that we saw during 2022 is that the dips are being actively bought. And we can see this the whole way up from mid-April all the way through to current day. It's that's what we've been seeing. We've seen those dips being bought, and pullbacks have mostly only lasted just a few days. You can see some of them just really like 2 or 3 day pullbacks, and the market goes again. The fact that this is the longest pullback since the April low suggests that money is still looking for a way into the market. So it's really been a case of buying the dips, not selling the rallies, and that's a sign of a market where money is still trying to get into it. I think it's a case that the path of least resistance is up, and I think we should be looking for opportunities to participate in the rally. I also think it's worth having a quick look at the equal weight. So this is the ASX 200. Now let's look at the ASX 200 on an equal weighted basis. And I like doing this as well, comparing the two, because it's like the bigger stock and the smaller stock in the top 200 are weighted the same. So it's not overly influenced by a few large stocks. So the rebound over the last week or so hasn't been quite as strong as in the ASX 200, and so much of the strength appears to be in the big caps, and in particular CBA. CBA is up about 7.5% in the last week and a half. The equal weight, it remains below this key overhead resistance. So this is this blue shaded area above. I can just compress that a bit, show you where it starts. So it takes in the highs from February, a couple of highs from late last year, and also the high from late 2021, early 2022. So it's a pretty significant sort of technical area which prices are currently butting into. I think there's a good chance we see some more consolidation, maybe below this resistance in the near term. And ultimately, though, I do think we're going to see the ASX 200 equal weight move to new highs. I think it's probably a matter of timing. And for the ASX 200 generally to sustain an ongoing rally, it probably needs that broad participation and a breakout in the equal weight to new highs to sustain that rally in the main index. I think just coming back to the ASX 200, I think this overall structure across both the equal weight and the index, I think it remains positive. We've got these rising moving averages, prices established above the moving averages. I think it's a case of continuing to play this from the long side. It's about doing what's working, and what's been working has been going with the momentum, not trying to pick an end to it. And as always, what I do with my portfolio, I use those wide trailing stops to try and see off the pullbacks like we're having now. See off the pullbacks, see off the consolidations, try and stay on that larger trend should it continue to run.
Yeah. I wonder if, obviously there's D-Day for the tariffs coming up very soon as well that Trump's going to impose. I wonder if that's going to affect the markets. Let's have a look at the US. Obviously the Aussies stalled a little bit, but the US is running hot, right? So let's have a look.
Yeah, very, very much, Rog. So a new all-time high for the S&P 500 on Monday. And this has just been one of the most extraordinary rallies in history, both in terms of its size and its speed. So it's up about 28% in just 11 weeks. So that's you don't see many rallies like that. And it's been extraordinary also in terms of the market's resilience to extreme uncertainty. So you just mentioned tariffs a moment ago. There's conflict going on elsewhere. These are normally things that are known to spook markets. Uncertainty markets often don't like, but new all-time highs. So the market knows there's these uncertainties out there, but it's still moving higher. So I think it's a bullish sign when markets react favourably to what could be considered negative news. And I think that when the market also another thing is when the market rallies this much over a couple of months, there's been a strong historic tendency for further gains over the next year. And that's been the case when we look back to at least the late 1980s, that big rallies over short spaces of time tend to flow on to further gains over the year ahead. Of course, there's pullbacks, there's consolidations along the way, but as a general proposition, tends to be bullish price action, not the precursor to a bear market. When we look at this chart, I think the structure here is clearly bullish. We've got the rising moving averages, prices above the moving averages, and it's been a clear upward progression with the rallies. So we get the rallies, we get short consolidations, and then we get further rallies, and that sequence has continued the whole way up. Like we discussed with the ASX 200, that's a sign that I think there's buyers waiting to get in on dips. Hence, these dips are so shallow and relatively short. Very different to what we saw during 2022 when the sellers were waiting to unload stock. So let's have a quick look back at what I'm referring to in 2022, because I mentioned this with the ASX 200 as well. Like, look at these rallies during 2022. There's several notable rallies, but on the pullbacks, we didn't see the support. So just look at how they peak and then they quickly about face. And so there's no notable buying on the pullbacks. The pullbacks aren't supported, they're not shallow, they just give way to lower levels. Now compare that to what we're seeing in current day, and the pullbacks are finding support. There's buyers beneath there, and it pushes the market higher. So the price action is very different in its structure and the way buyers and sellers are operating to what was seen previously, or what we saw in 2022. Quick look at the Dow Jones. That's had an interesting week. I like this price action that we've seen in the last few days. So prices are rallying off the moving averages. You see the 1500-day moving averages here. Prices had been traveling sideways for about 5 weeks. You can see this area through here where we had this sideways consolidation along the moving averages. Now we're lifting off, we're rallying off the averages and breaking out of this compression regime that had been in place, where the price action just got narrower. Nice rally off that in the last week. Moving averages have also crossed. So the 50-day is now above the 100-day. And now that's a key factor for a sustainable upward trend. We want to see the shorter moving average above the longer moving average, and that's the first time that's occurred. That's been the case since back in March. So that's a notable development in the last few days. And we're seeing similar price action in the equal weight. So S&P 500 on an equal weight basis. again, we've had this sideways consolidation above the moving averages, and now we're getting a breakout. We're getting a breakout from this sideways compression, prices to breaking to the top side, and I think this is important because the equal weight, for that to rally, the rally's got to be broad based. There've got to be lots of stocks participating, and that's an important factor in a healthy bull market. You want that broad participation, and I think this breakout in the equal weight confirms that we do have that broad participation. Just on the topic of participation, just quickly, this is an indicator I like to keep an eye on. This is a percentage of S&P 500 stocks above their 100-day moving average. And so when the indicator's down towards the bottom, it's showing relatively few stocks are above their 100-day moving average. When it's up near the upper end, that's showing that a lot of stocks, most stocks in fact, are above their 100-day moving average. What we have here over the last couple of months is that over half of stocks have moved to being above their 100-day moving average, which is positive. And now we've had this sideways consolidation in the indicator, much like we've had in the equal weight. And now it looks to be on the verge of breaking higher. And currently there are 61% of S&P 500 stocks above their 100-day moving average. And should this indicator break out, well then it's likely going to move into the mid to high 60% region, maybe into the 70s in the coming weeks, and that would be a sign of more stocks participating in the rally, and in turn likely lead to the higher prices. So I think it's encouraging and it's positive that we're seeing more stocks above their 100-day moving averages. Just to wrap this section up, back to the S&P 500. I think this overall structure, I think it's positive. Prices are above the rising moving averages, and the price action suggests that the interest is in buying the pullbacks, not selling the rallies. I think it's a case of going with what's working, and as I said with the ASX 200, managing risk with trailing stops, because at some point markets there will be larger pullbacks, and those trailing stops just help manage risk.
Yeah, and we'll get onto that actually around process very soon. But let's have a look at the Hong Kong market, Jace, if that's all right.
Yeah, well, a nice rally off the 50-day moving average over the last week for the Hang Seng. The dips continue to be bought, and we have a series of rising lows and rising highs. So the path of least resistance for the Hang Seng, it's higher. I've been thinking we could see some more consolidation, but that hasn't happened. It's been this constant push higher with the rising lows. So I think it's a case of going with momentum, going with what's working. And China's an interesting one, the Chinese market. So what we had last week, price had this nice rally off the moving averages last week, but then they quickly turned and they've come straight back to around the 50-day moving average, and they reversed right near the May and the March highs. Let me just draw a line across there. So they reached resistance from these previous highs, and then they've quickly reversed back to the moving averages. And this has been an ongoing theme in the Chinese market. It's often struggled to hold on to gains. So get these good rallies, but then can quickly give them back. So that theme has so far continued. What will be interesting here is whether the selling pressure on rallies, so we get these rallies and the selling comes in, what will be interesting is if this selling pressure can be maintained, or whether it in fact becomes exhausted. And it's when you're in these range bound sort of periods and you get the sellers towards the top of the range, at some point we often find that the sellers do run out of stock they want to sell, and prices can break to the upside. And that's when you get the potential for a strong and sustained rally. That potential then comes into focus. So when we step back and we look at the the Chinese market. Look, I just wonder whether this is like a large basing period over several years. So we've had a big bear market. Could this be a large basing structure during, say, 2023, 2024? And then we look at what's been happening over the last 8 months, and whether this is a basing phase in the initial push higher. So we've got the initial move to the top side. Is this another basing phase before another push higher? I think the key here is to wait for a breakout to the top side. And for me, I'm looking at these previous peaks from May and March, and I think if we see a break above there, I think that would be a signal that the basing's over and a potential rally is getting started. May not happen, but that's just the look this price action has to me. It looks like it's basing type structure before prices try and break to the top side, and then we'd possibly have the early stages of a new advance with these rising lows turning into rising highs as well. Prices also, moving averages are slowly slanted upwards, but if it were to accelerate, well, then you get price above rising moving averages. That's how bullish phases can start. So certainly one to watch. I think be ready to act on this one if you're interested, and we get that price breakout.
Fantastic. All right. Great wrap up of those four major markets. Before we move on to the tickers, Jason, because we always bring this up, and I want this to be our sort of lesson for this week. I think because I read some amazing way to look at the process of investing and trading. Right now, it doesn't matter whether you're fundamental or technical, whatever, sentimental, right? Always having that system. And it's easy for us to look at a chart now where it's all the way up and going, look, we're bullish. But if you followed us throughout that 20% drawdown, we were always there trying to stick with the system and getting out of our positions that were no longer favorable and staying in the positions that were. So we were managing that and not panicking throughout that whole period, right? If you're new to this, you just have to go back a couple of months to shows and seeing how we were talking about that down period. But what I wanted to sort of preface, and you always talk about the trailing stops, is the importance of sometimes not worrying about the P&L at the end of the day as being a good day or a bad day. Is if you're in the red, it's a bad day. If you're in the green, it's a good day. Or the black, it's a good day, right? But rather looking at the process that you follow. What's your trading plan? Have you followed that trading plan for the day? If you followed that trading plan, as in you haven't cut your winners early, or you've made sure you've cut your losers when they were meant to be. Have you followed that trading plan? If you follow that trading plan, it's a green day. Right? If you haven't followed your trading plan, like I didn't a couple of weeks ago, I broke my trading plan, and I positioned size too high, too big in one of my portfolios that I had, and I admitted that on the show here. I've managed to get out of that position now at the same price, which is great. But following that process, if you follow it, it's green. If you don't follow it, it's red. I think that's a fantastic way of looking at things, Jace. What do you think? What have you?
Yeah, so we're taking the actual numbers out of the equation and looking at how we action our rules. So I think, look, I think that's a good point, Rod. Just like a good day is a day where we follow our process, and yes, we want to see green in the portfolio all the time. We would like to see green in the portfolio every day, but of course that's not going to happen. We're going to have the days where there's down days, there's down weeks or months. But the key is have you followed your process? And no matter whether you're a fundamentalist or a technical or what style of each that you happen to follow, everyone's going to have periods where they lose money. Like no one makes money day in, day out. It doesn't work like that. So I think the best we can do is just try and be consistent with our approach. And I think it's consistency over time that really gives then time the chance to deliver us strong performance, not on a day-to-day basis, but on an overall medium to longer term scale. I think if you can follow a consistent process, it's probably going to be rules based if it's going to be consistent. If you can do that, then I think you give yourself every opportunity to do well over the time. I know it's hard not to get hung up on some big down days, which are going to happen from time to time. But if you can just try and bring it back to, am I following the process? Like the idea with like trading rules is that we design the trading rules when everything's calm and we're cool and calm. There's no great issues in the day, and we go, okay, this is how we should operate at all times. And so then when things do become difficult and you do see the red days in the portfolio, you can give yourself a green day through process management by following those rules and maintaining that consistency over time.
Yeah, I think it's detaching yourself from the monetary or the end result as well a little bit, because what we tend to do, I think, is whether it's through instant gratification or whether it's through it's always about that end result that we have in our higher mind so much. But if we detach ourselves from the financial part of the process and think that if we followed our plan, then it's not saying that it should go perfect, but if we follow our plan over a long period of time, once again, you detach yourself from that financial, and you're not making decisions or rash decisions based on that P&L figure, which I'm sure 99% of people in the stock market are the ones that don't have the rules and don't have the processes probably do, right? But detaching yourself from that financial position, it's good to see, but I think long term would be so much better for most people, right? So
yeah, I also think separate trading money or trading/investing money from everyday money. Like, don't have an account where you're paying for the groceries and buying shares in the same account. I think that's where you don't want different types of money to mingle. You want your everyday money over here, and you want your trading money over here, and you shouldn't relate the two. So you have a down day, you shouldn't say, well, that's next month's rent money gone. It's like, it's not next month's rent money, it's trading and investing money. Rent money's over here with your grocery money. Don't merge the two. Don't think of investing capital in don't link it to everyday items. Don't link it to a holiday. Don't link it to clothes or whatever it may be. It's they're just digits in an account, and we use those digits to apply rules, and then over time hopefully make money, and then you can of course withdraw some of that money, bring it over to your everyday account. That's the way I try to do things. I don't want to be it can help diffuse the emotional strain of good decision making. If you're thinking, look, if I get this wrong, well, then I can't go and do this in the everyday world. Well, then it really does put the pressure on to get everything right, and you're not going to get everything right. So separate the two, I think, is a good, generally speaking, a good way to approach things, and try and reduce the emotion of following a good process and set of rules.
yeah, great tip there as well, right? So just remember, the next time you're going to have to stop out of that position, are you using your P&L as a decider, or are you using your rules? If the idea is that if you're using your rules, it's a green day, and even if you're out on that position, at least you followed your rules, right? So, all right, so fantastic. Thanks for your comments and thoughts there, Jace. I just thought that would be a great thing to bring up for people in the way to look at investing and trading. So, thanks for your commentary around that. Let's get on to some tickers as we normally do. I'll try to get onto two of everyone's, and then if there's by a certain time, obviously, if there is time, I will circle back and get to the others as well. All right. So let's kick off with Jennifer's. Hey, Jennifer. And by the way, happy. You're in finance when you get wished happy new financial year, Jason. I think I've had it about 10 times already. So yes, James, happy new financial year to you as well, and everyone else. All right. Let's get on to our tickers. Jennifer, LYC, please.
I haven't looked at this one for a little while. This will be interesting. And yeah, it continues its volatile march higher. Um, yeah, look, if I had this one, I'd be happy to continue holding it. It's what I find a little disconcerting is that every time we get these strong rallies, we're also getting these sharp retracals. So see, there's a sharp rally, and now another sharp move back to the moving averages. It'd be nice to sort of like see a rally that then holds on to most of its gains, get a sideways consolidation and another rally, but instead it's really like accentuating the zigzagging steps higher. But nonetheless, it is moving higher. We have rising lows, rising highs. If I was on it, I'd stay on it. If I really wanted to buy it, like it's pulled back to the 50-day moving average. It's like, I don't think I'd buy it today. But if somebody really wanted to get on board this one, I'd prefer to buy it probably on the moving averages, and when it's stretched above the moving averages, which it can quickly move into that state. If buying it now, look, I probably wouldn't need to give it too much room to prove itself. It's if it gets, I'd say like if it fell about 8% from here back below the 100-day moving average, then it would have given back most of that recent rally, and it would really start to make it look a little bit more neutral again. Yeah, it's a stock I could really see continuing to go higher, but it'd be nice to see it settle down a bit and not be so hard to hang on to.
All right, fantastic. Thank you. Let's get on to Hassan's EUR, please.
Yeah, we looked at a few lithium stocks last week, and this has that same general appearance. It's like we discussed this last week. Is lithium at a turning point, or is it just more sideways chop? There's certainly potential here. It's moved from below the averages to above. It's just oscillating either side of the moving averages at the moment. And it's such a low price stock as well. So it's one of those ones which is probably a little bit harder to manage risk on. So I think buying it at current levels, I think it's probably asking for at least a 35% stop back below the moving averages and back below this low point from late June. So I think it's probably a difficult one to buy at the moment. I'd probably watch this one if I wasn't in it and see whether we get sort of like a bit of sideways price action like such while the moving averages start to turn higher. Then it could be a case of like buying it in a couple of weeks if we get some sideways price action, or then buying a breakout from there. Then we might have some good points to manage risk around. But we don't even get that price action. I'm just like discussing setups I'd look for, which could give an opportunity. If I was in this one, if I happened to buy it at lower levels, well, fine. I'd be happy to stay in and see where it goes. But I'd probably not. I'm probably more inclined to watch it than buy it at this point.
Yeah, very good. All right, DB, hello from Bangkok, 34 degrees. Lucky you. Let's get on to Roger, who's got CBA.
Rog, if it was 34 degrees here, we'd now be saying it's too hot and humid. So we're hard to please.
Exactly, Australians.
So
make money as well.
That's it. So CVA, look, the trend here is in place. It's been in place since back here in 2023. This rectangle's been left on from an earlier time where we got a breakout, and you can just see how well trends can work when they go, and why we give them room to move, because it has had several pullbacks to the 100-day moving average and even below, but a wide trailing stop would have been able to see off all of that pullback and still be on the trade. So if I was holding this one, I'd still be holding it. Do you buy it at current levels? It becomes a harder question when you think about, like, would you be buying it at current levels? It has pulled back a bit towards the moving averages. Is going to consolidate a little bit more. For me, it's probably more a case of like holding what I've got rather than looking to to buy at this point. I think I'd probably be looking for other stocks which are maybe starting to rally off their moving averages, or breaking out of ranges like this did some time ago. But certainly a hold for me if I was in it.
All right, fantastic. Another West Farmers, please, from Roger.
Yeah, it was starting to get that sideways consolidation. So it did have this nice run, got above the averages, probably got a little bit away from them, and now we're getting the consolidation. I'd be happy holding it. And I'd be probably happy just watching how the consolidation plays out. If there's some more in it, I think there could be some more in it. Maybe it ties in with what I was saying with the ASX 200. Maybe it can just come back and just do a little bit more of this sideways price action. If we see a bit more sideways as the moving averages catch up, maybe it's a case of buying towards the lower end of the range near the moving averages, and then seeing if it continues to run. But at this point, trend remains up, and I'd be happily staying on board. Again, wide trailing stop could have kept you in this one the whole way. That's why we use wide and not 10 or 20%, because these pullbacks you see along the way typically take out people who set close stops, 10, 15, 20%. They usually get knocked out during those periods. So they find it very difficult to stay on these larger trends, which can play out over maybe 2 or 3 years.
Okay. All right. Maurice now. WAF, please.
Trend's still up, although we have had that sharper pullback. It's gold orientated, I believe, and this is typical of what we're seeing in a lot of the gold stocks. We have had that sharp pullback towards the 100-day moving average. At this point, the trend remains up, wide trailing stop. We've seen this before, where prices come back to and below the moving averages, while still maintaining an uptrend. So at this point, I'd be giving it the benefit of the doubt and staying with the overall trend. But as always, just having an exit planned in mind, because at some point the trend will have a big correction, whether it be in the near term or from much higher levels in the future. We don't know. So always have that exit point in mind. But for me, it'd be like, this is a motion trader stock. There'd be a calculated motion trader trailing stop on it, which I don't know offhand, but it's probably back towards like 180 or maybe even a bit lower, giving it lots of room to move around.
Okay. The next one is CNB.
Did I get that right, Rog?
CN for Nelly and B.
Oh, B. Yeah, so we've looked at this the last couple of weeks, I think, and we've got this series of rising lows. The moving averages are now starting to cross. So this pretty much meets meets my entry criteria. Probably won't appear in the motion trader signals, or maybe it already has. Not quite sure it's familiar, but it's familiar probably because we speak about it a bit as well. It's just whether the volatility would keep it out of the motion trader portfolio. But it's meeting those criteria. It's making new highs, moving averages are crossing, series of rising lows. I think this is one I'd consider. A stop maybe probably needs at least 25%, just back below maybe the June low, back below the moving averages. If this sequence of rising lows continues, well, using the June, the late June low would be a good reference point for an initial stop. And now if it can consolidate above the averages, maybe it can run again. So if I was in it, very much happy holding it. If I'm not in it, I could consider it at current levels.
Fantastic. Let's get on to Kirby's. TUA.
So this was this was a great trend. I was in this one myself. I think I was in it from back in 23 somewhere. A terrific trend, periodic pullbacks to the moving averages, but the wide trailing stop kept me in for a long time. A motion trader stock. It was this pullback, this sharp pullback in March, which caused the trouble, and it triggered the I think it actually triggered the wide stop loss. That sharp pullback in March. So I'm out of this one at the moment. If someone's still in it, there's probably it has recovered back to the moving averages, but it's lost some momentum. It doesn't have that same momentum which it had previously during 2024 and early 25. I'm probably neutral on this one at the moment. It's if it breaks above the high from if it breaks above last month's high, well then maybe you say, look, maybe there could be some momentum returning. But for now, I'd be inclined just to watch this one. It's probably not. It's not a buy for me here. If I was still holding it, sure, I could keep holding it. But you got to work out like where's your exit point. So if you're still holding it and you were holding it last year, like you sat through a big correction. So what does that say about your exit strategy? Where do you exit a stock? Do you have a strategy, or do you just hold and hope for the best? And I think that holding and hoping for the best, I think, has problems attached to it because yes, so far this is working out. It's rebounded, but what happens? What happens when they don't rebound? What happens when they chop under the moving average and then they start to break low and you get this sort of price action over time? You just keep holding on, hoping it's going to recover. So I think we've always got to consider where's our exit strategy when things go wrong. Not a buy, but if I was in it, I'd want to know where I was getting out.
Okay. NEU.
Yeah, look, an example of what I was just discussing, why we need to sort of know when we're getting out. Had a nice trend in this, really good trend in this, but then it gave way to lower levels, and that will happen. I'm probably not quite ready to get back into this stock. I like the price action that's gone from below to above the averages, and we're getting the consolidation. So it sort of, for me, goes on the radar of one which is probably worth keeping an eye on. This could be a basing period that it's going through. It also could have a bit longer to go. Like we could see some more sort of like sideways price action. If we do get some more sideways price action, I'd probably be interested on a break higher. That could be a good risk reward entry point. At the moment, I'm probably just watching this one. If I'd already jumped in and got some, well, I guess I could manage risk pretty simply at the moment. I could just have a stop below the June low. It's probably about 20%. So below the June low, below the moving averages. That could be one way to manage risks if I was already in. But otherwise, I'd watch it and see whether we get consolidation and a breakout.
Okay, fantastic. Thank you. Can we have a look at Zip, please? It's bouncing back. Is it time to buy?
Jesus, this has been a tough one. The widest of trailing stops would have been triggered during this sell off, and I know because it was a motion trader stock, got stopped out. Now it's come firing back, V-shaped recovery. I wouldn't be a buyer at current levels just because it's like stretched above the moving averages. I'd want to see what the next consolidation looks like, where when we get a pause, doesn't move sideways while the moving averages catch up, or have some sort of a pullback towards the moving average, stabilize, and then start to turn higher. So I don't know how that will look. So I'd probably just be watching this one. If I jumped in a bit earlier, happy to stay on it and see where it goes. Some trends are more difficult than others. We had the nice smooth part of the trend during 24. other than a buy and hold type of approach, it's very hard to see off such large corrections. Like how big is that? Like that's a 70% correction. It's not reasonable to say, look, I can sit through that sort of correction with a wide stop, because I don't think you can. I think the only people who can sit through that sort of correction are ones who are just they're just rusted on supporters of the stock, or they're just hoping for the best. And I don't think either strategy is terrific, because it doesn't give you an exit mechanism when things go wrong. So yeah, I'd just leave this one alone for the time being.
All right, Jesse, AZ9. He's in at 2.6 cents. Not sure where this could go short term.
Yeah, look, I'd have to leave this one alone because it's trending lower below declining moving averages. It's like, what makes this point different to this point in June, or this point in April, or this point in March? It kind of looks the same in that it's just a few days off a low. There's nothing to say, even though it's only 2.6 cents, there's nothing to say it can't go lower. Nothing to say it can't get down to 1.1 cent or something, which is a fall of like 60, 70% or something. So yeah, it's only 2.6 cents, but from there, there's still 100% possible decline. So yeah, I don't want to be playing when the momentum is to the downside. It's not to say that it can't go up, but there's nothing here for me to say, look, I think this is a good risk and reward. It's even say buying at current levels, say, look, I really like this stock, I'm going to buy it at current levels and put a stop below the recent low. You're still looking at 25%, and it's a complete punt because the momentum is still to the downside. So yeah, one I think to be unfortunately left alone for now.
All right, Roberto, let's have a look at MEI, please.
Yeah, the makings of something here. So it's gone from below to above the moving averages. We've got this sideways movement, and from that sideways, there's been a bit of an upward bias to it through June, and now again a shallow pullback to the 50-day moving average. So I think this could be bought at current levels with a stop. Probably needs probably needs at least 25%, 25 to 30%. More aggressive would be maybe, say, 20 to 30%, 20 being the most aggressive, 30% is like just giving it, using this low from May as a final final support point. Alternatively, it could be a case of buy if it breaks higher. So if it continues to hold the 50-day moving average and then get a break, buy the breakout. So if you're buying it maybe 14.5 cents as opposed to 12 cents, so you pay a bit more. So you talk about paying, what might that be? Paying an extra 20%, but then you're going with more momentum and there's more rising lows and rising highs to go off. So there's a couple of ways that could be done. I think there's upside potential in this one. Doesn't mean that it's going to be delivered, but there's a setup there which I think produces an asymmetric opportunity where we can say risk is say 20 to 30%. Should our stop loss be filled? And upside is open-ended. Who knows where it could go? Could it double? Yes. Could it go more? Yes. Doesn't mean it will, but you've got those asymmetric properties. So play that sort of risk reward makeup time and time again. You be wrong half the time, be right half the time, and you're going to probably do pretty well. Probably do very well.
All right, exactly. Let's have a look at K's, which is BBAI, please. Must be a US stock.
Big Bear, and Big Bear's off. Not a dissimilar pattern to what we were just talking about with meteoric, and there's gone from below to above, and you've got this sideways movement along the moving averages, then it's exploded higher. So, not to say meteoric's going to do that, but that's how this sort of pattern can develop. Um, if I was in this, and it had a nice breakout point too, the structure was all there. We had this sideways compression, initial rally back to the averages, and then the breakout. So had I bought on the breakout or during the sideways consolidation, I'd happy be holding it now, although I wouldn't be buying it now because it is stretched above the moving averages. I'd be waiting for the next consolidation to see what it looks like if I was considering buying some. But if I had it, yeah, happy holding it.
Okay, fantastic. Bud, BUD.
Yeah, trends up, pull back to the 50-day moving average. Whether this develops into a long-lasting trend, or whether it's just like this has been like really tracking sideways since 2020. So what we have off the lows so far, look, it doesn't look dissimilar to what we saw during 2022 into 2023. It was a rally, but it didn't really kick on with it, then sort of came back into the range. So are we going to see something similar this time? Like, there's no way to know, and but that's okay. So if I had this, I would hold on in the and give it every chance to continue higher. But if it comes back within the range, well, I might, yeah, I'd probably then close the position out and move on to something else. But someone else might say, look, I'm happy holding this medium, longer term. Whilst it's in the range, I'll collect dividends and see if it turns up later on. So there's different ways, different levels of patience you can have with a stock, as long as it's not breaking down. And within a downtrending phase, I've got no problem holding a stock while it travels sideways. So yeah, for now, I'd be seeing where this momentum goes. See if we can find support at the 50-day moving average as a first step, and then see if it can then push on the new highs. But yeah, there's upward momentum at the moment, so see what happens with it.
All right, let's get on to Ifrans. KAR, please.
Yeah, this is holding up well given all the volatility in the oil price. It is a motion trader stock, this one. I think the signal might have been back in early June. That probably would have been the point. Yeah, I'd be happily holding this one. Probably wouldn't buy it just yet. It's in that pullback phase, and it's still a fair bit above the moving averages. If I wasn't in and I was thinking about it, I'd probably just watch it for a little bit longer and just see whether it does continue to find support around current levels. But at this stage, it does seem to be interested in buying this dip. If you look at like a chart of the oil price, it's come straight back down. Given back all of its gains, where this not the case with Karoon. It's holding on to most of its gains. So yeah, I'd be happy to hang on to this one, and if it can continue to find support, yeah, it could be one to consider buying in the next over the next maybe week or two.
Okay, TSO.
There's no momentum to speak of here, and it really just has been a sideways meander for the last couple of years. I'd probably be inclined to leave this one alone. I'd rather just go with some momentum, even if I like the story. There's no momentum to drag me in at the moment. At the very least, I'd probably be like, I could look at those highs from earlier this year and say, well, look, if the price can break above some recent highs, get the moving averages turning higher, well, then I can come and have a look at it. But until it does something like that, and if it does something like that, I can sit back and say, look, I don't need to put money at risk at the moment because there's no immediate momentum in this stock. So rather than get in and possibly just have a stock that continues to drift, I can do something else with the capital. And should it break out, well, then I'll pay a bit more. But then there's some immediate momentum, and then I can see where it goes from there. So yeah, for me, not just at the moment, but look, it's no harm in keeping an eye on it.
All right, Tinker tables from sunny Brisbane. Let's have a look at. We've already looked at KAR, so let's have a look at LOT, please.
A little bit early. Maybe it's starting to turn, but I'm just wary of it at the moment because it could also just continue downwards. Like, yeah. In its favour, I like that the rally off the June low, it's like a strong rally, and then we've got this corrective looking pullback to the moving averages. So it's held on to most of those gains. It's held on to most of these gains from that mid June rally. So that's in the positive camp. In the negative camp, though, the moving averages are still, they're starting to turn upwards, but yeah, it could also be a case of like we saw during January, where they start to turn, but then the whole structure just gives way to the downside again. It's not that different to the current structure, not that different to what we saw during January. So there's like, look at that. There's an initial nice rally, held onto the gains, but then gave way into a large decline. So I couldn't rule that out, that a larger decline doesn't kick in. So I probably don't want to buy it at the moment. If I was holding it, I could use the June low as a cutting point, as a stop loss point. If it can continue to stabilise here and then break higher, well then I can get interested in. So I can see it's worth keeping an eye on, but not for me just at the moment. And yeah, you've got those reference points to look at. Got the low, got these recent highs, break above those. Maybe we're getting momentum. Break below the low, well then maybe we're entering another decline phase.
All right, let's have a look at another one from Tinker Table. APX, please.
Sorry, what was that?
APX.
Yeah, I'd probably leave this one for a moment. A lot of damage done, a lot of technical damage done with that sharp sell-off and then ongoing decline. So it's a bit like Zip without the V-shaped recovery at the moment, in that there was a great rally, but even a wide trailing stop, it can't see off pullbacks like this. It then gives back pretty much all the previous gains. So I'd be out of this one. And in its favour, I like the rally off the May low and the pullback so far. It's held on to part of the gains. It does look like a corrective, choppy, overlapping decline. But I think there's more work to be done. First step is it's got to get above the 50-day moving average. It's not above there at the moment. So that's why I'm inclined just to leave it. Let's see what the price action over the next few weeks brings. It's probably not a short-term proposition for me. It's going to take a bit more time to potentially turn this around, if that's in fact what it does. So yeah, one I'd be just leaving alone for now.
Okay, fantastic. Comments around comments, Jennifer. Before we get on to the next ticker, I think the comment, maybe it's different on different computers, but maybe the comment section opens up after the live video is finished. Obviously, you've got live chat at the moment. Just check that out. They'll probably, if you go back to the video after the comment section should open. I love the comment here. 78 Little Mogo Creek. Thank you very much. 78 people watching, only 11 likes. So please do like and subscribe. I'm going to throw this in right now. Like and subscribe and do your best to promote the show. We really appreciate you coming as always. So thank you very much for the pump up there. Much appreciated. Now let's get on to the next ticker here from I think the next one here is AL3 from Evangeline, please.
Yeah, well, that's sprung to life from being in this sideways, no trending sort of period. So yeah, if I bought some of this on the breakouts, the breakout would have been, watching these previous highs. So that was the breakout coming on, when's that, last Friday. Yeah, I'd happily hang on to this one. I wouldn't buy it at the moment though. It's just too far from its moving averages. There's probably going to be some sort of a consolidation at some point, not too far away. And then I'd watch what the consolidation looks like and maybe look at getting some then if I wasn't already on board. But yeah, if I was on board, happy hanging on, wide trailing stop, and see where it goes.
Yeah, thanks, Daniel, for helping out Jennifer there with your comment. Grant is asking for WAF.
Oh, we've looked at this. That was West African.
It's the one we've already looked at. Okay.
So, yeah, so we had a look at this one early on.
Okay, yep. Let's move on to SRG.
Trends up. It's a motion trader stock. Motion trader's got a calculated trailing stop for it. That's what I'd be using. I'd be letting the trade run. Probably not a buyer because it is stretched above the moving averages. But yeah, if I was holding it, I'd continue holding it.
Okay, another one for Mr. Leftovers, and this is from the New York Stock Exchange. So it's Edelweiss, EDEL. Wise. So that second one there, I think. That's it, yeah.
Oh, okay. No, that's the Indian Exchange. That one. NSE.
Yeah, NSE. That's the one he wants. Yep, NSE.
Yeah, we've got the makings of something here. So we've gone from below to above and started to get the sideways consolidation, but then it's just popped higher in the last couple of days. So if I had it, I'd be happy holding it. It does meet my entry criteria in that the 50 and 100 days have crossed. It hit a 70-day high on Friday. So that would be an entry trigger. So this is a stock I could buy it at current levels. Stop loss is going to be back below the moving averages. So that would be probably needed. I'd probably give this at least 20%, and see whether it builds into something. But the overall structure's there. So yeah, go with the momentum.
Okay, fantastic. The next one's from Sydney, IDP, please.
Where is it?
IDP.
Yeah, I don't see that one here.
Brilliant. All right, let's have a look at BHP. On that one.
Is it not IPD by any chance?
Well, let's have a quick look at that one, if it is.
Sometimes we get the letters reversed.
Yeah.
Look, if it's this one, it's a downtrend, so I'd just be steering clear. There's no upside for me in trying to pick the turn in these downtrends. Like any way along here, we could have been saying, "Oh, look, is at the end of the downtrend, and is at the end, is at the end." It just keeps, is at the end, and that can just keep going. So don't try and preempt the end of a downtrend. Let the downtrend signal that it could be over with good price action, and that is firstly getting above the moving averages. So BHP and
we'll start with
BHP is still below these declining moving averages. So I don't want to try and pick a low on it. It's like discussed this in the past, how I bought a position when it looked to be breaking higher last year, but then when it got back below the averages, I just cut that position out, and there hasn't been a need to be in it, and that's still the case. Now this could be the low, and it could be back at $40 in the next few weeks and consolidating above the averages, and then that could be the setup to get involved. But until that happens, I'm happy just to go, okay, well, there doesn't seem to be a hurry here because there's the tendencies for prices to be falling. So I can have the capital doing something else, keep an eye on BHP. I think there's probably a great trade there at some point, but it's just not now. And these things can take longer than you expect. Like BHP's been, it's been largely moving sideways for a few years. There's nothing to say it has to turn now. It could, but it could also drift for some time longer.
CSL looks much the same, to be honest. That was another one from Sydney, but I think you just...
And it's the same general situation. The problem with CSL is, like, is it sort of like breaking out of this large ranging formation it's been in since 2020? So it's been a long time just going back and forth. I don't know. I don't know whether this lower mark is really working now. We had a false break in 23 and now it's like getting a bit messy. So all that's really doing is just sort of like marking a kind of lower end of a range. But yeah, look, I wouldn't want to be buying into this. I think the risk with this stock is that this compression that we're seeing in the price action, that I think the risk is that it resolves to the downside. So yeah, I don't want to be involved while that possibility is very much in place.
Okay, fantastic. EL8.
So it's the uranium play. I've got some of this, and it's some of the uranium plays are doing better than others. So look at Deep Yellow. So Deep Yellow's up on its highs and has had quite a good run. And then we look at EL8, and it's back from its highs back towards the moving averages. So it hasn't run as well as some of the other ones. That said, the structure we have at the moment is still okay. So we've got we've got a strong rally, and we've got a corrective looking pullback so far just to above the 50-day moving average. I wouldn't want it to lose too much more ground. So if it finds itself back looking like such, well, then I'll be closing the position out and I'll go and do something else. So I think it really does need to hold the line here. But if it does, this is a sort of structure which could lead to an advance to like rising lows. So it's certainly not without prospects at the moment. So as I say, I've got some of this myself, so I'm not going to add to that position. I think 31 and a half, I think I got in at. So it's just below where I got in. I guess if you like the uranium trade and you want to get a position, or you like this particular one, I think it could be bought at current levels and it could be done on a fairly close stop. Oh, well, I think it probably needs I'd probably want to give it at least 14. It's probably still 20%. I think it's probably still a 20% stop on this one. But if it moves, it can move a bit. So 20% is probably a good risk reward level. It's an asymmetric play from 31 cents. Could it be up at 60 cents? Could it double? It certainly could. So 20% risk probably seems like a reasonable play for a stock which can really get some movement going when it does. So yeah, it's going to be interesting to see how this one plays out. Whether this structure above the moving averages does resolve to the upside. That's my bias at the moment. But I can get these. My biases don't always work out, so we'll see how this one plays.
All right, LRV. Have we looked at this one? LRV?
No, I don't think so. little bit early for me. Nice rally off the lows, but I want to see some more price action play out. It's not it's poking above the moving averages, but not by much. They're starting to turn, but they're still negative. So it's it. I think it just needs more work. If I was already in this stock, I'd probably use the lows from June as a point where I'd say, look, enough's enough. It's not working out. But for now, I just watch it. I probably want to see it maybe rally a bit further and then sideways consolidation, hold on to its gains, and then a secondary breakout. So that could take, say, 2 to 4 weeks. It could do something completely different, require longer. But I think it needs at least a few more weeks to give us enough price action to firm up a view on it. So one to, I think, keep an eye on.
All right, thanks for that. Michael asks for a few here. Let's start off with PFE.
Was that an E or a V?
E.
Well, downtrend's still in place in this. It's been in place for a long time too. I'd just steer clear. It's like, yeah, price has been pushing higher over the last couple of months, but it's not that different to what we saw from November to March, and that result of the downside or a larger version during 24. I'd just leave it alone. Still, the moving average is still generally tracking downwards and is below the 100-day moving average. Maybe it's so low, but the odds probably favour that we should respect the downside risks to this one still.
All right. Now there's a bit of
and also just on this one, you just look at this, and there's a whole lot of resistance just above current levels. So if it were to break above, get back up to around 26, well then I think we start paying a little bit more attention to it. But at the moment, I wouldn't be preempting a turn. I'd be happy to pay an extra $1 or $2 and possibly get in at a higher level rather than going in now. I think risk reward favours waiting, not preempting.
Okay, now Michael, I'm not sure if you want us to look at this one, but let's look at the first comment you've posted around CLOV. Let's have a look what that looks like.
Well, this is I wouldn't be buying this one at the moment, and if I was in it, I'd be thinking about where my exit point is, because we do now have the declining averages, and the prices is becoming more entrenched below the moving averages. I think that there's definitely downside risk in this. It could accelerate to the downside. The bad stuff tends to happen below the moving averages. Yes, it may base sometime around here and start pushing higher, but I'd be concerned about the downside. So if I was holding this one, oh look, it's already down 44%. I think if I was in, I think I'd probably be out. I don't think I'd be holding this one any further. It's probably come back too far, and it would have probably triggered a wide trailing stop. And I don't want to buy it at this point because it's on the wrong side of the moving averages. So probably one that I'd steer clear of. It's not to say that it can't base and make a comeback, but it just, if we keep buying stocks below declining moving averages, I think we end up with too many that underperform. Yes, some will probably come good, but it's not where I want to bat from. I want to bat from this side of the moving averages, not the underside.
Okay, fantastic. So obviously, don't forget, we're making recommendations or making sort of, our opinions are based off technicals. Obviously, if you've got a fundamental reason, like you've explained there, Michael, then it's certainly up to you whether you want to stay in it or buy it. So let's have a look at BGD, please.
Yeah, what a great uptrend, and it's still in place. I'd be happily holding this one. I'm probably not buying it at the moment. Gold's consolidating at the moment, but this one is trending higher. It has been stretched above those averages, and it has come back a bit. It's very much for me a hold and see what happens.
All right. Next one's from Bryce. We've already looked at BHP. Let's have a look at WDS, please.
It's come back to the moving averages with the oil price being volatile. I'd probably be inclined to just wait and watch at the moment. Like I spoke about Karoon Energy, KAR earlier, which I like. It's a tricky one. Do you just buy the pullback to the moving average and say, okay, this is turning. It's gone from below to above. It's pulled back, so let's buy it here. Or was this just a spike higher with the spike up in the oil price, and now there's the oil price couldn't go on with it. It's come all the way back. Is it going to drag the stocks down? I'd probably still be careful playing in the energy space because there is just so much volatility at the moment. I prefer it when you get a break, then you get the pullback is supported, then you get another break higher, rather than price action, which is swinging in a volatile fashion in either direction. If I had some of this, particularly if I bought some, if I got in a bit lower, there's no problem with holding it and sort of like thinking, look, where would my exit be? Maybe if it starts breaking back down through $20, I'd say, look, enough's enough. It's not working at the moment. I'd get out. But if I was thinking of buying, I'd probably just watch for a bit longer, see if we sort of get it tracking sideways a bit, and then you start getting a bit of a break high and consider getting in then. I just don't think this is a clear cut position at the moment. It's had its first move from below to above. Now let's just see what happens with the consolidation and the oil price.
Okay, fantastic. MTM, please, Andrew.
Wow, well, this one's up and away. Let uptrends run and see where they go. And that's what I'd be doing here. Letting a profit run, wide trailing stop. I'd be giving it lots of room. I'd be like, my trailing stop would be back probably below 30 cents, back around the 100-day moving average. Wouldn't be buying it. It is stretched above the moving averages. But like, who knows where it can go. So maybe it goes a lot further, maybe it doesn't, but we don't know. So we let profits run, and some trends will go longer and further than almost anyone expects. Maybe this will be one of those. You never know which one that's going to be until we look back in hindsight. But to have that potential, you've got to let profits run. So I'd very much be doing that if I was holding this one.
Okay, let's circle back to some of the ones from the start. TLS, please. We've got a couple more right at the end as well, and we'll probably go through about 5 more. So
trend here is up. We've been speaking positively about Telstra for a few months since it started to break higher in February. Did really well during the volatility in April. So I'd be very much holding on to this. Bit of a pullback developing, so I don't think I'd be buying it today. Just see how this pullback plays out. But yeah, happy to hold, wide trailing stop below the 100-day moving average.
Fantastic. DXB.
Yeah, bit of a messier stock, this one. Like, we've got this big gap higher, and then it's given back all of those gains. Look, if I was holding, how far has it pulled back from its highs? Yeah, look, if I was holding some of this, particularly if I was in from from lower levels, I could probably give this a little bit further, maybe just below the June low. But it's I don't like that it's like a gapped high, then it's given all those gains back. Um, the structure's just not clean cut, unfortunately. So I'm probably a bit more neutral towards this one. I wouldn't be buying it. If I was in it, I could give it a little bit longer. But sometimes the chart structure is not overly clear. This is just one of those. So I can't give too many more insights on that.
Okay. Sydney, we've already looked at AL3. Let's look at EBR, please.
Yeah, I would have been out of this one if I was in it. It had the makings of a trend, but then it just gave those gains back quickly, and it hasn't rebounded with the market in recent times. So it's becoming established below the moving averages. Moving averages are in decline. If I was holding it, my line in the sand would probably be the June low. Breaks below the June low, I'd just say, look, enough's enough. I'm out. Maybe it can recover from here, but I'm certainly not a buyer at this point, and I'd be looking at where my exit is if I was holding.
Okay, Findi, Findi.
If I was riding that nice trend in 24, I would have been my trailing stop would have triggered late last year, and I'd now be on the sidelines. It does seem to be finding support, which is good. Getting support down around 364 thereabouts. But it could continue to trade sideways for a bit, so I'm not in a hurry to buy at the moment. Moving averages haven't turned higher yet. I think it's an interesting one to watch. Like I could see how an uptrend could develop here. Like you get some more sideways, then you starts to ratchet higher. I could definitely see how something positive could develop, but it hasn't developed yet. It's just sort of like seeing how it could sort of like come into play. So I think one to keep an eye on. If I was already in, I'd be probably wary of this 364 level. If these previous lows start to break, then we've got a stock which is then breaking lower below declining moving averages. I'd probably want to be moving it on. In terms of buying, I'm not quite there yet, but yeah, keep an eye on it and just see whether we get a structure that says, look, the risk reward is now in our favour.
Okay, DYL.
So with the uranium stocks,
that's the one we looked at.
Yeah, I briefly clicked on it before. So if I was in this, very much very happy to hold it. In terms of do I want to buy it at this level? Probably not. I wonder whether we do get more of a consolidation developing while the moving averages catch up. So I'd hold off buying because if I buy it now, where am I going to put my stop? I've got to have a stop back down. Oh, look, it's 25% maybe. I've probably got to have a 25% stop on it. It probably could be bought with a 25% stock, but it does seem to be elevated above that 50-day moving average. So I'd probably prefer not to do that. I'd be happily holding, but I'd be waiting if it wasn't in.
Okay, LLY.
Not much going on here. It's just consolidation. There was a great trend in play. It generally does look like a big period of consolidation. It's like, how do you structure it? Like, is it like some sort of like a downward trend channel site, consolidation? So it's like a slightly downward sloping trading range. But it's got to break high from there. So the fact that it's all overlapped and crisscrossing itself suggests it's corrective. But I wouldn't be ready to buy it just at this point. If I was holding it, yeah, I could stay in it, and I'd probably be looking at this low point from April, a bit below there, to say, look, enough's enough. It's now starting to get too many lower lows, and it hasn't been able to regain upward momentum. So I might move it on. It depends. If you're a long-term holder and you've owned the stock since back here in 2017, well, that's probably not what you do at all. It's you might be just. I'm talking about from a medium-term active investing perspective when I discuss these stocks, not buy and hold. So I'd be considering where my exit point is had I got on and rode a trend for a year or two. But in terms of buying, I probably want to see it. Maybe it's got to break out of this range that it's been in. It's I don't think there's a rush to do anything. I think we can just watch the price action over the next coming period, next weeks or couple of months, and see how it comes together. I'm really looking for some upward momentum out of this sideways period to say that it's time to get more exposure or get exposure. And it's wait and watch at the moment.
All right, let's look at two more. BEN, please.
Yeah, look, I'm probably neutral here at the moment. Like we've got the highs from February, and then we've got the lows from April, and it's kind of within a big range. So if I was holding it, fine, I can continue holding it and have a stop below the 100-day moving average. So I'm giving it quite a bit of room, but I'm probably not coming into buy. It's not a clear structure. It's just like it's come down, fallen rapidly, rebounded. It's I'd be watching the next consolidation, see whether it stabilizes around the moving averages, and maybe that gives us an opportunity to buy something which is about to then try and rally again. But for now, it's just, again, it's one of those ones which doesn't really give a clear read. Just lots of recent volatility. So I'm probably inclined just to leave this one.
Okay, and the last one's JBY, please.
It's so really has been in a corrective mode for the last 6 months. Interesting that it's got these strong upward moves, and then you get these corrective declines. Strong upward move, then another climb back to the moving averages. So it's not really being able to get escape velocity and really start to run. It keeps being pulled back to the moving averages. Look, it's not one I'd buy at the moment. If I was holding it, well, yeah, I could probably give this a bit more room. Maybe I'm looking at looking below maybe the May low, or at the most looking below the April low as an exit point, and see if it can accelerate to the upside. In terms of buying, I'd probably not ready to do so at the moment. Maybe it's another break above the June high. If it can break above the June high, then maybe it can start to get some momentum together. But yeah, it doesn't sort of suggest a clear play at this very point in time.
Okay. All right. Fantastic. Thank you very much, Jason. Thank you, everyone, for coming along and bringing your tickers as well. Lloyd, you got a question around New Zealand stocks on the ASX around dividends. I don't know. Do you know? I mean, Neville's answered it, basically saying that all New Zealand dividends get paid in AU. Is that the case, Jace? Do you know? Probably better off checking with the company, really, or the.
Yeah, I'm not sure.
Yep. Better off as always checking with the company or the share registries. Those sort of questions could be.
I know when I'm holding a New Zealand stock, I get paid in my Aussie bank account in Aussie dollars.
Yeah. Okay. Fantastic. Thank you once again. Don't forget, everyone. This is we're general advice only. If you've got some amazing reason that you want to be in a stock or stay in a stock or buy a stock, please do so. As always, be careful out there in the market. We appreciate you coming along. Thank you, Jace, once again for another fantastic week.
Rog, it's been fun as always. Covered lots of ground as we typically do, and hopefully it's been interesting. Hopefully it's been helpful, and look forward to next week.
Exactly. So we do look forward to next week, and hopefully you'll come along and join us once again. Thanks, everyone, and have a great week ahead. Take care. Bye-bye.